on Business Incorporated today. Zimbabwe hikes interest rate to 200%. IMF loan to Kenya for budget funding delayed. And World Bank gives Morocco $250 million for transport connectivity. Hello and welcome to Business Incorporated, the first one for the week. I'm Ini John Mekwa. Well, let's start off as usual with major markets in Africa. In Nigeria, the market seems to be continuing in the green this week, starting off intraday up 0.48%. Meanwhile, GSE index is the biggest mover, up over 2%, 2.5%. Egypt's index also was laggard at intraday. It was down more than 1%, and Kenya closed negative on Friday, almost 1%. In the Middle East now, it's all negative. Abu Dhabi jumped 0.32%. Also Dubai in the green, 0.49%. Meanwhile, Saudi Arabia and Qatar were negative, down 0.04% and 0.21% at intraday. Let's go to Berlin now. Ukraine is top on the agenda for the G7 summit, which began yesterday and runs for the next 2 days. The members have discussed banning further imports from Russia, gold being on top of that, getting the much-needed grain shipment out of the country, and potentially capping oil prices. Well, we have joining us now Stephen Bursley from Berlin to tell us what exactly we're expecting from these talks, especially as it connects to Germany. Hi, Stephen. Good afternoon. What's the biggest issue at the summit now?
Ukraine is indeed the top issue, and these G7 economies are going to focus on how best to tighten the sanctions that they've already put in place and potentially put new sanctions in place against Russia. Remember, these economies are the ones that have led sanctions against the country to this point. They've gotten buy-in from other allied nations in the G20, for example, and other nations around the world. So this is the formulation ground for these actions against Russia. There is some concern that many of the sanctions put in place so far haven't had the short-term effect that many would have hoped. In fact, we've seen prices for natural gas and oil rise in recent months, and that, in theory, puts more money into Russia's war coffers. We've also seen more nations rushing to import more natural gas and oil from Russia as they fear that bans on both fossil fuels could come in the future. In the case of an oil ban that is set by the EU and by G7 countries for the end of this year. So that's what they're looking ahead to. These nations, these economies are going to try and make these sanctions more targeted and more precise, and they're then going to have to sell them to the nations around them, to partner nations. They're also going to have to sell them at home, where inflation is a major issue in all G7 economies. And much of that inflation has been driven by rising energy prices. Those energy prices affected, of course, by the war in Ukraine and by the sanctions that the G7 has put in place.
And the meeting is for the next 2 days. How much progress can we expect at the end of this meeting?
Well, we've already heard an announcement of an embargo from G7 economies on gold shipments out of Russia. That's more of a formalization of an understanding that was already there, so that's not really a breakthrough. I think all eyes will be on this oil price capping mechanism that is under exploration. What they would likely agree to is to continue discussions or to formalize discussions on a mechanism. And what this would do essentially is create a kind of buyer's cartel of major oil importing economies, beginning with the G7, hopefully going out to the G20 is what those economies would hope for, and then other partner nations as well. And what that would try and do is take the major economies who are buying that oil and let them fix prices. And that does two things. One is that it limits, in theory, the revenue going to the Russian state, which can be used in the war. And it also has a positive effect on inflation by capping prices at a certain point. Now, the question will be the role that emerging economies in particular can play in regards to this price capping scheme. And all eyes are really specifically on India. India in recent months has really taken advantage of the sanctions against Russia to buy discounted Russian oil. They've increased their imports, and they could play something of a spoiler if they continue doing that. India, South Africa, Brazil, these nations are all participating in some of today's discussions at the G7 summit, so they will be there will be a lot of jockeying to get them on board, but we will see how that goes.
Yeah, we'll certainly see how it goes, Stephen, because countries looking out for themselves is first. But what else is likely to shape markets this week in Europe?
Well, this week marks the end of the first half of the year, and it's been quite a roller coaster for markets. Major exchanges generally down for the year on fears of recession and fears that monetary policy across the board is going to be tightened. However, we saw on Friday that Wall Street really boomed a bit after some new economic indicators suggested that monetary policy might not have to be tightened quite as much as feared, and that's because consumer confidence is falling. Itself not a great thing, but that confidence in exchanges and stock markets, that is increasing today. We've seen that European markets have actually done well. They've started in positive territory today. But all eyes will be on the G7. It will be on some other indicators as well this week, including Chinese industrial data that's coming out later. That will give us a better understanding of the overall state of the global economy, the overall demand that's out there. And then we're going to see some EU inflation data later this week as well. But in general, all eyes are going to be on this question of what is coming. Is a recession around the corner? Will monetary policy need to be tightened so much that it makes a recession more likely, and we're going to see money move accordingly?
Yeah, well, tightening monetary policy, we ask how effective it's been so far and how far or how high will it go. Thank you so much, Stephen. Enjoy the rest of your day. Let's move to London now, and in London, the story is not so different. Juliana joins us now. Good afternoon, Juliana. Well, again, we have petrol price hitting fresh highs, and especially like on Saturday, I think that was the last day of the strike for last week. I don't know what's up for this week, where commuters had to switch to their cars because of the rail strike. Have we heard the last of it? And this fresh highs in petrol?
Good afternoon, Annie. Well, to go with the second point of strikes, unfortunately, the striking season isn't over just yet. We had last week the biggest industrial action that the UK has seen in about 100 years, because the RMT decided to put down their tools on Tuesday, Thursday and Saturday. That was combined with the London Underground strike on Tuesday. And unfortunately, for anybody hoping to have a stress-free travel to Wimbledon, because we have got the start of the tennis tournament this week, it is not going to be the case, because Croydon Tramlink drivers who are connected with the ASLEF union, they are going on strike tomorrow and on Wednesday. A similar story that we heard from the RMT union. They are not happy with conditions, with pay and with their overall job. I believe they've been offered a 3% pay rise, but their bosses say it's just not enough. With inflation running at 9.1%, a 3% pay rise is in a pay cut for some instances. So that is that. We're also going to be expecting more train strikes from the RMT union this summer. Unfortunately, the Secretary General of the RMT union, Mike Lynch, he's been doing the media rounds as to be expected this weekend. He spoke to the BBC saying that unfortunately discussions with the government has just not improved. So they are expecting to strike soon. You were right about petrol. It's pretty windy here in London. You're right about the petrol prices over the weekend. Another new record high. To fill an average family car of petrol cost £105. And that's just a shocking amount, because again, of course, we've been speaking about this cost of living crisis that's really crippling families up and down the country. Many of them couldn't use the train, so they have opted to use the car, and it's just so high at the moment. I think motoring association groups are a little bit concerned, because what they projected a couple of weeks ago is that motorists will start seeing prices decrease because wholesale prices are coming down. That's not happened just yet, so I'm expecting probably more conversation between motoring groups like the RAC and the AA with the Transport Secretary Grant Shapps, as well as the Business Secretary Kwasi Kwarteng, to see why these a reduction in wholesale prices is not translating to a reduction at the pumps.
All right, and the G7 is ongoing, and Britain is one of the voices talking about banning Russia gold. What are the possible impacts?
Well, yeah, this is a really interesting story. Of course, we'd expect that when the G7 meet, considering that Ukraine is a top story, that they would go on in trying to cripple Russia's economy. That's what they've been trying to do over the past couple of months, although the results that they were expecting to see just haven't yielded thus yet. The bombardment of Ukraine continues, and now they have decided to hit where it hurts most, which is gold. We know that, particularly in a volatile market, lots of experienced investors do put their money in gold because it's a safe haven, and I think there are some suggestions that some Russian oligarchs have been trying to avoid some sanctions by investing in gold so that they can try and sell it elsewhere or just keep it for that rainy day. And the rainy season has approached because out of the G7, the UK, the US and Canada and Japan have said that they will try to implement this ban to hit the Kremlin where it hurts. I believe last year Russian exports of gold came to the value of about £12.6 billion. Much of that money was invested in London, which is why it's seen that Boris Johnson, as he has been doing, must take a very swift approach. So I believe that legislation will be passed through Parliament in the next couple of weeks to try and get this ban on Russian gold. And yes, it is to try and cripple the Russian economy, because apart from this suggestion that this debt financing interest payment wasn't made over the weekend, we see the Russian ruble has been climbing extensively week on week. But I think that the planning is that once this gold ban and trying to cap the price of Russian oil will really hit the Kremlin.
Well, we're looking into that. But what's the market looking like at this time?
Markets are looking pretty good in London at intraday. The FTSE all-share is up by 0.71%. The FTSE 100 is up by 0.67%. And the FTSE 250 flying high, trading up by 1.17% at intraday. The British pound is down against the US dollar, though, down by 0.12%. Also down on the euro by 0.22%. But at intraday, the British pound is trading up against the Japanese yen by 0.06%, Tinny.
All right, Juliana, thank you so much. So let's move on to Asia now. Shares in the Asia Pacific traded higher as investors assess inflation and recession fears. Hong Kong's Hang Seng Index led gains in the region to end the day 2.35% up at 22,229.52 after trading more than 3% higher in this session. The Hang Seng Tech Index popped 4.71%. Alibaba shares in Chinese City rose 3.69%, while Meituan was up around 3.48%. Mainland Chinese market also gained. The Shanghai Composite climbed 0.88% to close at over 3,000, and the Shenzhen Component rose 1.1%. Japan's Nikkei 225 gained 1.43% to close at 26,871.27. Other topics rose 1.11% to 1,887.42. In Australia, the S&P AX 200 advanced nearly 2% to over 6,000. The Kospi in South Korea gained 1.49% to end the session at 2,401.92, and then Kosdaq was 2.71% higher. MSCI's Broad Index of Asia Pacific shares rose 1.72%. In the United States, Dow futures gained as stocks try to come back. U.S. stock futures rose following a major rebound last week from this year's steep declines. Despite the bounce, Wall Street is preparing to wrap up the worst first half for stocks in decades. Dow Jones Industrial Average futures rose 0.3%, while S&P 500 futures gained 0.4%, and Nasdaq 100 futures advanced 0.5%. Those moves followed a major comeback week that saw the Dow Industrials jump more than 800 points. The S&P 500 popped 3.1%, and the Nasdaq Composite surged 3.3%. In the oil space now, prices edge higher today in a volatile session as investors waited for any moves against Russian oil and gas export that might come out of the meeting, the G7 meeting, which is ongoing in Germany. The prospect of even tighter supplies loomed over the market as Western governments sought ways to cut Russia's ability to fund its war in Ukraine. Even though G7 leaders were also expected to discuss a revival of the Iran nuclear deal, which might lead to more Iranian oil exports. OPEC Plus will likely stick to a plan for accelerated oil input increases in August when they meet on Thursday. But for now, pressing supply worries outweigh growing concerns over the potential for a global recession following a string of downbeat economic data from the United States, which is the world's biggest oil consumer. OPEC member Libya's national oil company has said that it might have to halt exports in the Gulf of Sirte area within 72 hours amid unrest that has restricted production. Well, Brent crude futures rose on all of this to $113.58 a barrel after rebounding 2.8%, while U.S. West Texas Intermediate crude was at $107.82 a barrel. Let's go on a short break. When we come back, we have stories from the African continent. So stay with us. This is Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated here on Channels Television. Well, we'll start with Kenya. The Nairobi Bourse has been termed the third worst performing major stock in Africa since January, hit by foreign investor capital flight and ease of repatriation of equity sales compared to other capitals in the continent. The Nairobi Securities Exchange was ranked 8th among the 10 top markets in the continent, with a return of negative 30% in dollar terms since the year started, wiping out 789 billion shillings of investor wealth. Well, Ghana and Egypt tie the knot as the worst performing on the continent. But we have to tell us how this is affecting Kenyans at this time. Joining us now from Kenya is Limo Tamboy. He is a financial expert joining us from Kenya. Hi, Tamboy. Good afternoon.
Good afternoon, Ini.
So we do know that major factors driving this is capital flight. But what's causing the capital flight?
As EFG report, with the leading stockbroker in the region and one of the research top in Africa, showed foreigners are exiting the market. And this is normal. I think with the event in developed markets, there's a kind of a step down of investment in emerging and frontier markets. And Nairobi, as you said, it's easy to exit and enter. And so they are using this market as a way to recoup some profits.
So does this tell us anything bad about the economic health of Kenya?
No, I think it's fine. It's a normal situation. I think the challenge currently is that the gap of foreigners who account for about 55% of the daily trading, and that gap would normally be filled by large corporate investors, that's insurance and pensions. And currently they have more appetite for government debts, and because that's an easy alternative for them. And retail investors, Nairobi is very active in the retail investor market, but retail investors really come in when there is a large privatization program. And unfortunately, this government for the last 10 years has not done any major privatization. So retail investors are the ones who would fill the gap. But I've no doubt within 2-3 years, the market will come back up to recover all the losses of the last few years.
Yeah, I wanted to ask about that retail investors, especially because back here in Nigeria, we also had a huge, percentage of foreign investors leaving the local bourse, and then we had the local investors step in. Are investors looking that way in Kenya?
I would say the large corporate investors in Kenya are certainly looking forward to, over the next few years, there are people who are buying these opportunities as prices are coming down. I think the concern with many foreign investors is that this is a chance to take some profits out based on the performance of the last few years. The main stocks which they buy are Safaricom, Equity Bank, KCB, and these are companies who are all making huge investments currently. So you have Safaricom going to Ethiopia, Equity Bank going to the Democratic Republic of Congo, KCB is expected to follow them there. And this will be a period of investment for them, so not super high profits. So it's a chance to, I think they'll be back in a few years. I'm not worried about this period.
I guess it's the long-term holders that would see the opportunity and try to cash in on it at this time. Well, thank you so much, Limota Boy, financial expert, joining us from Nairobi, Kenya.
Good day. Thank you, Ini.
We're still staying in Kenya, where they may need to find an alternative source to finance their current budget deficit. And that's because of a delay by the International Monetary Fund in issuing a 28 billion shilling loan. That's $238 million. The funding is part of a $2.3 billion extended credit facility, an extended fund facility that was agreed to by the IMF more than a year ago for budget support. The loan needs board approval after a staff-level agreement with the lender was reached in April. The board is only expected to meet in coming weeks to give final approval, according to an IMF official. And from there, we go to Zimbabwe, where Zimbabwe Central Bank and its Monetary Policy Committee has decided to hike its policy rate to 200%. Going from 80% per annum. And it takes effect from July the 1st. That's just in a couple of days. The committee noted that the increased inflation was undermining consumer demand and confidence, and that if not controlled, it could reverse the significant economic gains achieved over the past 2 years. Still staying in Zimbabwe, the Home Affairs Department has said that it had received applications to drop one of its requirements for Zimbabweans applying for a general work visa. The deadline for Zimbabweans who were on the exemption permit to legitimize their stay is fast approaching. In November, government announced that the permit would expire at the end of this year. One of the requirements for the issuance of a general work permit is that the Zimbabwean national must have a certificate from the Labor Department, which considers the special skills list or a waiver. The Home Affairs Department said that it was processing more than 3,000 waiver applications, while some have also applied for the issuing of the labor certificate to be completely scrapped. And the World Bank has approved $250 million for an MA Northeast Economic Development Project, which aims to improve transport connectivity and enable private sector growth in northeast Morocco. It is focused primarily on the development of the Nador West Med Port Complex. Nador is located in eastern Morocco, just south of the Spanish enclave of Melilla. Morocco is implementing a major infrastructure investment plan, including the development of NWM Maritime Complex, which includes a deep sea port and an industrial zone, as well as actions to improve the regional business environment. The project has three main components, which is to strengthen the integrated territorial development approach in the Northeast region, to support private sector development, and to improve road infrastructure. The project will finance the development of a priority investment roadmap, improvement of a 500 kilometers of rural roads, and the skills building of 5,000 young workers, with emphasis on women and rural youth. That's the program for today. We made it through. We'll do it again tomorrow. I'm Ini John Mekwa. Enjoy the rest of your day.